Let's get back to the Fed here. For more on these minutes and where yields are going, let's bring in Wall Street forecaster Jim Bianco. He runs Bianco Research. Jim, last time we talked, you think rates are going higher, 5.5%. You still stand by that. Was there anything out of the minutes that you thought was interesting, especially considering we had a lot of Fed speak after that Fed meeting, which led the markets to really believe that 6 rate cuts were happening next year?
Yeah, no, I thought that Steve did a good job, that the minutes came in a little bit more hawkish, or we might say a little bit more balanced than people had expected, that it wasn't the type of minutes you would have heard if the Fed was getting ready to cut 6 times this year. And so I think on balance, it was suggesting that the Fed might be a little, if I could use the word, stickier in cutting rates. I mean, it doesn't mean they won't cut rates. It's just it might not be as aggressive as everybody says. To your first question, yeah. I've been arguing for many, many months that I think that the 10-year yield could go to 5.5%. That has not been working for the last few months. But I also see an economy that's doing okay. And I see inflation that might, to use the word again, sticky, around 3%. And so I'm going to stick with that, that I think that, before 2024 is out and probably towards the middle of the year, we might see new highs in yields and maybe closer to 5.5%.
Jim, what is it on the back of inflation reemerging or the economy suddenly surging and reaccelerating to the upside? What does that move higher in yields look like?
No soft landing. I don't think we're having a soft landing. And if I was to stick with the metaphor, I think we're having a no landing. I think that the economy is doing what it does 90% of the time. It is continuing to expand at trend, which is about 2.5% growth, or maybe a little bit better. So 2.5% growth. If inflation is bottoming at around 3%, which is roughly where we are now because demand is going to hold in, you add the two together, you get 5.5%. And that's where I come up with 5.5% for the yield, that's nominal GDP, that, the 10-year yield should approximate where nominal GDP is. So where I'm differing from Wall Street's consensus is I don't think we're going to see a slowdown. I don't think we're going to see a soft landing. I think we're just going to continue to see trend growth, or maybe a little bit better than trend growth. And that's basically what we saw in 2023.
So, Jim, I think your 5.5 was close enough for a win. I don't think we're getting back up there, but I do see some moving averages that can get me. The 100-day moving average in the 10 years is 439. The 200-day is a little bit over 4%. But the question I have to ask is where you started there with CPI. We went from 9% down to 3%, PCE running with a 2 handle on it. Isn't this good enough when you see inflation drop so fast? That could be the reason why they're cutting, not because the economy is in any danger?
Well, first of all, that PCE at 2% is only on a 6-month annualized basis for core PCE. So there's many measures, and that's the lowest measure you can get. The Fed has made it very clear that there is no close enough. We are going to get it back to 2%. There is 65% of the country that lives paycheck to paycheck, that prices are 20% higher than they were 4 years ago, and that we have to slow dramatically this rise in inflation. And 3% is not, this is not horseshoes or hand grenades. This is 3% is not close enough, that they have to continue to lean on the economy to get it all the way down to 2. Now they're hoping they've done enough that it's on its way. But if it turns out to be sticky, they might be a little bit more hesitant to cut rates as much as people think. So I do think that the inflation rate is key to this forecast. But I also think that we have not yet seen the numbers that suggest that we're really on that so-called last mile. Remember, year-over-year core inflation is 4% right now, and year-over-year headline inflation is 3%, and largely because of oil being depressed.
What's the timing of your forecast, Jim? In other words, you see rates, the 10-year yield going to 5.5%, but you still see 3 rate cuts. So do we hit 5.5% and then we see cuts kick in, and so then we see the yields back off? Or I'm just trying to figure out what you're foreseeing in terms of, trying to extrapolate this into how the markets trade this year.
So remember, the yield curve is inverted, and it's been inverted now for about 15 months. And that is an extraordinarily long time for the yield curve to be inverted, meaning short rates are higher than long rates. So if the Fed wants to cut once or twice, maybe 3 times, and bring the funds rate down into high 4s, and the 10-year yield goes to 5.5, that's a positive 75 basis point yield curve. So really what we're talking about is a normalization of the yield curve during the year. That in and of itself, to say, well, the yield curve will normalize, is not an unusual thing. What might be a little bit unusual about it is it would normalize in an environment of rising rates. It usually normalizes with rates falling. This one might be, where I'm talking about the long end of the yield curve, where rates are going up, that might normalize the curve. So keep in mind that what that is implying is that the yield curve goes positive again.
Oh, okay. I would think that's a good thing, especially for banks, Jim. Would you agree?
Yeah, I mean, it can be a good thing for banks, and it can be a good thing for, for lenders, because their cost of loans would go up. And it may not necessarily be a bad thing for the economy, because more long-term interest rates are what lending is tied to. And really what I'm also implying in this forecast is I don't think the economy's hurt by 5% interest rates. I don't think the economy's really hurt by 7 or maybe high sevens mortgages. It's certainly not helped by it, but it's not, it's not the old line that the Fed raised rates till something broke. I don't think something is broken because of these rates. And I think that's the assumption a lot of people are using. We broke something. We went too high in interest rates. That's why we're going to have to come down and we have to worry about a recession. I don't think we did. And that's why I think we could go back and revisit those levels.
All right, Jim, thank you. Jim Bianco,
Thank you.
Bianco Research.